Okay, hello everyone. Today we are going to start our new section in P4 or AFM Advanced Financial Management. And this section is called Risk Management. Okay. Now, risk management section is definitely going to provide you 20 to 25 marks in the exam. Therefore, it is highly important that you understand all aspects of this in order to ensure a perfect mark in this. Okay. Now, let me tell you the first thing that if we talk about risk management, topic of risk management is based on two areas. Okay, basically risk management involves two main areas. One area is called currency risk management. Okay, and the second area is called interest rate risk management. Okay, in the first risk portion, we will be dealing with currency risk management, and in the second risk portion, we will be dealing with interest rate risk management. Okay, so we will discuss step by step each of them. In today's class, we will be starting with topic number one, that is currency risk management. Okay, so I want you to listen to the lecture carefully, and then later on you can copy the stuff if you want, or obviously you will be watching this class. So if you want to copy, you can easily pause here and do the copying for yourself. Okay. Okay, so as I told you, we will be firstly dealing in topic number one, and topic number one is basically related to currency risk management. Okay, now let me explain you firstly. We are starting to deal currency risk management, right? You're starting to deal. This currency risk management. So firstly, you need to know the meaning of what exactly currency risk is. You are going to start in dealing currency risk management. So firstly, you need to know what exactly currency risk is. Now, let me read the definition. Currency risk is the risk that currency rates will go up if we have to make payment in future, or risk that currency rates will go down if we have to receive money in future. Okay, currency risk is basically the risk that currency rates will go up if you have to make payment in future, or currency rates will go down if you have to receive money in future. Currency risk is the risk that currency rates will go up if you have to pay money in future, or currency rates will go down if you have to receive money in future. Didn't get it? Let me explain. As we all know, the currency rates don't remain stable. They keep on changing at even seconds. Okay, the currency rates keep on changing. Okay, so let's suppose today is 1st June. Today is 1st June. I am in Europe. Okay, I'm in Europe. Okay, I bought goods worth $1,000 from a US supplier. Okay, I bought goods from worth $1,000 from a US supplier. I checked the rates. The rates were 1.05. The rates were 1.05. Okay, so I thought, okay, today's 1st June, I'm in Europe. I bought goods worth $1,000 from a US supplier, and the rates are 1.05. Okay, because I'm in Europe, my currency is euro. The rates are 1.05. So I thought that I bought goods worth $1,000 and the rates are 1.05. So I have to pay him 1050 euros. Now these are supposed rates, okay, not the real rates. Okay. The supplier was good. He offered me a 1 month credit and he told me that, okay, you pay me on 1st July after 1 month. Now, after 1 month, I went to the money changer and asked him that I need to send $1,000 to this bank account or to this address. Please send it. Money changer told me, okay, I will send $1,000. Give me equivalent euros. Whenever you go to money changer, he won't just oblige to you that, okay, send $1,000. He will ask, okay, give me the equivalent euros, then I will send. So you asked, okay, what is the rate? He told you that rate today is 1.07. So 1.07 for $1,000, you had to pay 1070. Now, when you came out of the money exchange shop, you thought that when you did the transaction, the rate was 1.05. You thought that you had to pay 1050. But when you actually paid, the rate was 1.07, you had to pay 1.1070. How much extra you had to pay? 20 euros. Was this a loss for you? Yes, this is currency risk. That risk that currency rates will go up if you have to pay. Okay, similarly, let's suppose today is 1st June. Okay, I am in Pakistan. Okay, today is 1st June. I'm in Pakistan. Okay, I bought goods worth 50 pounds from a UK supplier. On 1st June, I checked the rates. The pound rate was 200 Pakistani rupees. So I thought, okay, I have bought goods worth 50 pounds and the rate is 200 PKR. I have to pay him 10,000 PKR. The UK supplier was good. He offered me a 2 months credit and told me to pay on 1st August. On 1st August, I went to the money changer and I told them that I need to send 50 pounds to this bank account. Money changer won't oblige me. He would say, you need to send 50 pounds, give me equivalent PKR. I said, okay, I'm giving. What is the rate? He said, today's rate is 210 PKR. Okay, I had to pay Pakistani rupees 10,500. When I came out of the shop, I thought that when I did the transaction, the rate was 200. I had to pay 10,000 Pakistani rupees. But today's rate was 210. I had to pay 10,500 PKR. I didn't delay payment, did nothing. But just due to currency fluctuations, I was suffering a loss. This is called currency risk. That risk that currency rates will go up if you have to pay money in future. Okay, let's check the other side of the story. Let's check the other side of the story. Today is 1st June. I'm in Pakistan. I sold goods worth $10 to US customer. Today is 1st June. I'm in Pakistan and I sold goods worth $10 to a US customer. Okay. I checked the rates. The US dollar rate was Pakistani rupees 150. So I thought, okay, I've sold goods worth $10 and the rate is 150 PKR. I'm going to get 1,500 Pakistani rupees. Okay. The customer told me, give me credit. I told him, okay, pay on 1st July. Now, as per promise, on 1st July, he sent $10 to me. Now, when he sent me $10, this is of no use for me in Pakistan. I have to go to the money exchange and convert it. I went to the money exchange and told him, okay, take $10, convert it. He said, okay, today's rate is 140. Take care. How much did I get? 1,500. Now, when I came out of the exchange shop, I again thought that when I did the transaction, I thought I would be receiving 1,500. But when actually I received it's 1,400. There was no late payment, nothing. Just because of currency rates movement, I suffered a loss. This is called currency risk. So now try to understand what currency risk is. I told you the definition that currency risk is the risk that currency rates will go up if you have to pay, or currency risk is the risk that currency rates will go down if you have to receive. This is called currency risk. Whenever you are paying, there's always a risk that rates may go up. When you're receiving, there's always a risk that rates may go down. This is called currency risk. Okay. Now, there are three types of currency risk. Okay. The first is called translation. Translation means conversion. The second is called transaction risk. And third is called economic risk. Okay, try to understand the difference between all of them. What is the first type of currency risk? Translation risk. Translation risk is the risk of losses when financial statements of a company are translated, converted from one currency to another. Whenever you translate or convert financial statements from one currency to another, you may be exposed to a risk called translation risk. Like when you translate currency, financial statements from one currency to another, due to currency fluctuation, your assets may show lower value. Like let's suppose your assets were of $1,000, but due to fall in currency rates, when you exchange it, when you convert it, translate it, they may show lesser value. This is translation risk. Transaction risk, a risk of losses on any specific transaction, that is buying, which is imports, or selling, that is exports. Now the examples I gave you, these ones, this one, these examples were of transaction risk because you were suffering losses on any specific transaction. Either you were suffering loss on buying transaction imports or selling transaction exports. Okay, so what is translation risk? It occurs when you translate, convert financial statements from one currency to another. Transaction risk, risk of losses on any specific transaction, buying, imports, selling, exports. Whenever you are buying, you're exposed to risk, transaction risk. Whenever you are selling, you're exposed to risk, transaction risk. Like, let me give you an example of the examination fees which you submit. Now, students who are in UK, they have no problem in that, but students who are in outside countries and they are paying examination fees, let me tell you one thing, you all have faced this risk. Whenever you are paying examination fees of ACCA exams, you are always afraid that the rate may go up. This is what transaction risk is. And whenever you are receiving a gift from outside country, you're always exposed to that price may go down. This is transaction risk. If you are incurring losses on transactions. Okay. And finally, economic risk. Economic risk is the extreme form of transaction risk, that is risk of losses on both imports and exports. Now, if you import buy, the rates go up. And when you export, sell, the rates go down. If you're exposed to both risks, both buying, selling transactions are resulting in risk. This is called economic risk. Okay. All these are currency risk, remember. And I've told you the definition of currency risk at the beginning, that currency risk is the risk that currency rates will go up if you have to make payment in future, or currency rates will go down if you have to receive money in future. I gave you an example that if you're in US and you have to pay some UK pounds, you're always afraid that rates may go up, currency risk. If you're in US and you're receiving money, you're always afraid that rates may go down. This is a currency risk. There are three types of currency risk. Translation risk, it occurs when financial statements are translated from one currency to another. Transaction risk, a risk on any specific transaction, buying transaction, selling transaction, any specific transaction. And economic risk, when you're buying transaction, when you're selling transaction, both give you loss. This is called the extreme form, and its extreme form is called economic risk. Okay, so teacher, we have got this concept that currency risk is the risk that currency rates will go up whenever we have to pay, or risk that currency rates will go down whenever we have to receive. There are three types translation. It occurs whenever we translate financial statements from one currency to other. Transaction risk on any specific transaction, and economic risk is the extreme form of transaction risk. Is a risk on both buying and selling transaction. Now, our agenda is not just to tell you, okay, guys, these are the three types of currency risk and that's it. No, we are studying risk management. Okay, currency risk is the reality. You cannot prevent it. Whenever you have to pay, there is always a risk that rates will go up. Whenever you will receive, there is always a risk that rates may go down. You cannot prevent currency risk. However, currency risk is a reality, but we have to study how to deal, manage, or minimize currency risk, right? That's what we are here for. We have to study risk management, not just tell you what is the risk, what are the three types. Okay, go ahead now. We have to study what are the three types of currency risk, okay, and how to deal, manage, minimize currency risk. Now listen, this currency risk, if not managed, has the potential to significantly affect companies' profitability. See, importers and exporters. Let's suppose importers have to pay something and the rates go up, they suffer loss. You need to manage, minimize, or deal with currency risk. Now, how to manage, minimize, or deal with currency risk? Now, currency risk is dealt or managed or minimized through the use of hedging techniques. There are some techniques through which you manage, minimize, or deal with currency risk. Such techniques are called hedging techniques. Okay. Now there are 6 hedging techniques which we will be discussing. There are 6 hedging techniques which we'll be discussing. The first hedging technique to deal, manage, minimize currency risk is called deal in home currency. Second is called leading. Third is called lagging. Fourth is called matching or netting. Fifth is called forward exchange contracts. And the sixth is called money market. Okay, you need to learn how to deal, manage, minimize currency risk. So currency risk is dealt, managed, or minimized through the use of some techniques which are called hedging techniques. Okay, now there are 6 hedging techniques which we need to study at the moment: deal in home currency, leading, lagging, matching, netting, forward exchange contract, money market hedging. What are they? The first technique to deal, manage, minimize currency risk is called deal in home currency. Now, deal in home currency states pay or receive in your home currency. Deal in home currency states if you want to deal, manage, minimize currency risk, pay or receive in your home currency. I think that's quite valid. If I have to pay someone $1,000, I'm in Europe and I want to pay someone $1,000, I will tell them, listen, guy, I'm going to pay you in my currency in euros. Now, if you're paying in your home currency, euros, whatever happens to the euro dollar rate, there's none of your business. Okay. Let's suppose I'm in Pakistan. I bought worth $1,000 goods from some US company. Okay. I will tell them, listen, I will pay you in my local currency. So if I pay in my local currency, whatever happens to the dollar rate, there's none of my business. This is what ACCA does with you. ACCA receives payment. ACCA knows that there are students from around the world who are going to pay them. You have to pay in pounds. That's why if pound rate goes up, you suffer loss. ACCA receives payments in their home currency, local currency. So They receive payments in pounds. So whatever happens to the against rates of US or the euro, nothing happens to them. So if, for example, you are in UK and you have to pay someone $1,000, if the dollar rate goes up, you have to bear loss. Okay, you have to pay someone $1,000. Tell them, I will pay in my local currency. I will pay you pounds. So whatever happens to the dollar rate, that won't be of any effect to you. So let's suppose someone from US is willing to send me $1,000. I'm in Pakistan. If they send me $1,000 and I go and convert, I will suffer loss. Tell them, please pay in my local currency. If they send me PKR, no need to convert. And if there is no need to convert, whatever happens to the rates, fine business. Okay. Another technique to deal or manage minimize currency risk is called leading. Leading means making early payment. Leading means making early payment. Okay, pay early. The idea is if you pay early, less days, less movements in currency, less risk. Now, if I pay after 1 month, there are bright chances that currency rates fluctuate in 1 month. If I pay the next day, there won't be that much fluctuation. After 2 days, there won't be that much fluctuation. So pay early. If you pay early, less days, less time, less currency movement. Okay. The third technique is called lagging. Lagging means delay payment. If currency rates are adverse against you, make delayed payment. Because if you delay, get more time. Whenever rates fall, pay and then save money. Like for example, you had to pay on 1st July, but the rates were adverse. Request supplier, okay, I will pay you after 10 days. In the next 10 days, currency rates go slightly down, pay, you save money by delaying. This is called lagging. Okay, so the first technique is deal in home currency. If I pay and receive in my local currency, there is absolutely no chance I face any risk. Leading, early payment, and lagging, delay payment. Okay. The fourth technique is called matching or netting. Matching or netting is offset receipt and payment. Now, if you offset your receipt and payment, this will result in fall in currency risk. Okay, now for example, I'm in Pakistan. Okay. I have to receive $800 from US company and I have to pay $1,000 to a US company. Okay, I'm in Pakistan. I have to receive $800 from US company and pay $1,000 to a US company. Now let's suppose I settle this transaction in the way that I have to pay $1,000 to a US company. I go to money changer, tell them I want to pay $1,000. If the rates are up, bear loss and pay. Later, when I receive $800, I again go to the money changer. I received $800, I need to convert. He says rates are down, I suffer loss. Did I suffer 2 losses? Yes. So, do netting, reduce currency risk, deal, manage, minimize currency risk. I had to pay 1,000 to a US company and receive 800 from US company. Give authority letter to this US company. I wanted to receive 800 from them. Ask them to pay this 800 to this company. Ask them to pay this 800 to this company. Now, they paid 800. They had to pay 800 to you. They paid to them. Now you just go and pay $200 to them. Sir, I again have to go to money changer and tell them to pay 200. And if rates are up, I will again bear loss. Listen, firstly, you were bearing loss on full $1,000. Now you will only bear loss on $200. So did it got minimized? You can never eliminate this risk. The topic is not risk elimination, it's risk management. You cannot eliminate currency risk, you can only manage it. Okay, so matching or netting means offset receipts or payments. You are receiving $1,000 from somewhere, paying 1,200 somewhere, offset them, just pay 200 to minimize currency risk. Okay, so these are the 4 hedging techniques which we discussed, and through this currency risk will be minimized. The first technique which I told you, that technique was called the deal in home currency. If you need to minimize or manage currency risk, start paying or dealing in your local currency. If you're paying in your home currency or receiving in your home currency, any fluctuations won't affect you. Leading early payment, the idea is less days, less transactions, less movement of currency rates, less risk. Lagging, make delayed payment, because if you delay payment, risk will minimize. Matching, netting, you're receiving somewhere, paying somewhere, offset them. Okay. Now let's move towards some practical stuff. The 5th hedging technique to deal, manage, minimize currency risk is called forward exchange contracts. Okay. Now, before starting forward exchange contracts, I want to teach you one thing. And this thing is called rule of quotes. Okay. Before moving towards this thing, let me explain you, before moving towards forward exchange contract, that there is a rule of quotes. There are 2 quotes operational in financial markets. One is called indirect quote and one is called direct quote. You might have studied this in F9 financial management as well. However, we are repeating with you again. There are 2 types of quote operational in real world. One is called indirect quote, one is called direct quote. Okay. What is the difference between indirect quote and direct quote? There are three differences which you need to learn. Whenever you see that the foreign currency is in numerator and the local currency is in denominator, that's a sign of indirect quote. Whenever you see that foreign currency is in numerator and local currency is in denominator, that's a sign of indirect quote. Whenever you see indirect quote, remember, to convert from one currency to another, you need to divide. And whenever you see indirect quote, remember, lower rate among the 2 is buying and higher rate is the selling. Whenever you see currency rates, you see there are 2 rates. So if there is indirect quote, lower rate is buying, higher rate is selling. I have not made those quotes, you need to learn them. Okay. That if you look at currency rates and foreign currencies in numerator, local as in denominator, that's a sign of indirect quote. You need to divide to convert, and the lower rate among 2 is buying, higher rate is selling. However, if you see local currency numerator and foreign currency denominator, that's a sign of direct quote. Whenever there is direct quote, you need to multiply to convert. Okay. And the higher rate is buying and the lower rate is selling. Let me give you 1 or 2 examples before moving towards forward exchange contract. Let's suppose I am in UK and outside a newspaper shop or a money changer shop or on internet, I saw pound over dollars. So what is the local currency of UK? It's pounds. Since the local currency pounds is in numerator, it's a sign of direct quote. Local currency is in numerator, direct quote. Okay, once you got direct quote, in direct quote, you need to multiply to convert. And let's suppose there are 2 rates written, 0.97, 0.98. The lower rate is the sell rate and the higher rate is the buy rate. That's the rule of direct quote. That once you see local currency numerator direct quote, multiply to convert, 2 rates are written. The lower rate is the selling, higher rate is the buying. However, let's suppose you are in US. Outside a money changer shop, you see euro over dollar, 0.99, 0.96. Remember, you are in US. What is the local currency of US? It's dollars. Local currency is in denominator. What is the quote? indirect quote. You need to divide to convert, and the rules of indirect quote state that the lower rate among the two is buy rate and the higher rate is sell rate. Okay, you need to absorb or learn these two rules, that whenever foreign currency numerator, indirect quote, divide to convert, lower buying, higher selling, and whenever local currency is a numerator, that's a direct quote, multiply, lower selling, higher rate, buy. Now, before moving to a fifth hedging technique that is called forward exchange contract, let me give you a quick recap of what we have studied till now. We started with currency risk management. I told you the definition of currency risk, that currency risk is the risk that currency rates will go up if you have to make payment, or currency rates will go down if you have to receive payment. Okay, currency risk is the risk that currency rates will go up if you have to make payment, or risk that currency rates will go down if you have to receive payment. Okay, then I told you there are three types of currency risk. The first is called translation risk. Second is transaction risk. Third is economic risk. Translation risk occurs when FS financial statements are converted or translated from one currency to another. Transaction risk on any transaction, buying transaction, selling transaction, you get loss. Economic risk is the extreme form of transaction risk, risk of losses on both imports and exports. Okay, how to deal, manage, or minimize currency risk. Okay, currency risk can be minimized through hedging techniques. The first hedging technique is deal in home currency. Make payment, receive payment in your local currency. Leading, make early payment. Bagging, make late payment. Matching, offset receipts and payments. Okay. And we are moving towards the fifth technique. The fifth technique is called forward exchange contract. And before forward exchange contract, I have told you about two quotes, indirect and direct. So what exactly is forward exchange contract? Okay, remember, forward exchange contract is a hedging technique. It's nothing but a contract of rate fixation. Forward exchange contract is nothing but a contract of rate fixation. It's just a contract in which you fix rates. Like, for example, you have to pay your ACCA exam fees 1 month later. What is the fear in your mind? What is the risk? The rates may go up. You can't deal in home currency, leading, lagging, matching, whatever. One technique is forward exchange contract. You are afraid that you have to pay ACCA fees and the rates may go up. You go to any money changer or any bank offering this facility. You contract them and fix a rate. Okay, that I have to pay ACCA fees for £100 next month. I'm afraid the rates may go up. Let's fix the rate. They will contract with you to fix the rate. Now, if rates go up, you won't bear any loss because you have contracted at a specific rate. See, a company contracts to buy, sell currency in future at a specific date at a specific rate. Is a contract of rate fixation. I am receiving money from somewhere. Listen carefully. I am receiving money from somewhere. What is the fear in my mind? The rates may go down and I will bear loss. Let's just fix the rate. Let's just fix the rate. Go to money changer, tell them I'm receiving $1,000, but I'm afraid that the rates may go down. They fix a rate. Okay, let's fix a rate. If the rates go down, you don't have to bear any loss. We just fix the rate. You will get a fixed rate. I'm in US. I have to pay someone £500. What is the fear in my mind? The rates may go up. Fix a rate. This is forward exchange contract. You are likely going to get a calculation worth 2 to 3 marks regarding this. So let me tell you how it works. Okay. Question number 1. We are in Pakistan and we must pay $5,000 in 6 months. Okay, we are in Pakistan and we must pay $5,000 in 6 months. Okay, rates are dollar over PKR. We are given spot rate. Spot rate is today's rate. Spot means today's rate. 1 month forward rate, if you contract for 1 month later, you get these rates. 3 month forward rate, if you contract for 3 months later, you get these rates. 6 month forward rate, if you contract for 6 months, you get this rate. There are two rates, one is buy, one is sell. You will shortly be deciding yourself what is the buy rate, what is the sell rate. So we are in Pakistan and we must pay $5,000 in 6 months. Okay, we're in Pakistan and we must pay $5,000 in 6 months. The rates are dollar PKR spot, today's rate, 1 month contract rate, 3 month contract rate, 6 month contract rate. Okay, how much PKR will be involved in hedging under forward exchange contract? If you do forward exchange contract, how much PKR will be involved in hedging? Now listen carefully. Forward exchange contract. Okay, listen to the question carefully. We are in Pakistan and we must pay $5,000 in 6 months. We are in Pakistan, we must pay $5,000 in 6 months. Is there any risk? Yes. We are in Pakistan, we will be paying $5,000 in 6 months. There is a risk, rates may go up. We're in Pakistan, we must pay $5,000 in 6 months. There is a risk. You have to pay $5,000 in 6 months, the rates may go up. Okay, spot rate, 1 month forward rate, 3 month forward rate, 6 month forward rate. How much PKR will be involved in hedging? Now, if I'm in Pakistan and I have to pay $5,000 in 6 months, there's always be a risk that the rates may go up. What if you fix the rate to forward exchange contract? That's what the question is asking. How much PKR will be involved in hedging under forward exchange contract? Now remember, forward exchange contract is a three-step approach. First, you have to pay after 6 months, right? You have to pay after 6 months. Only this row will be used. Forward exchange contract is of 3 steps, okay? You have to pay after 6 months. Only this row will be used. I think it's quite fair. If you have to pay after 6 months, there is no need to look at the spot. Right? You have to pay after 6 months. So there is absolutely no point in looking at 1 month or 3 months or 4 months. No point. You have to pay after 6 months. So the only relevant row for you is 6 months. So this is step 1. The relevant row is 6 months. Okay. Second step, identify the quote. You are in Pakistan. What is the local currency of Pakistan? Pak rupees. That's coming in denominator. So it's an indirect quote and you will divide. Whenever there's indirect quote, you will divide. And the lower rate among the two is the buying rate, higher rate among the two is the selling rate. This is the second step. What is the first step? Highlight the relevant row. I had to pay after 6 months. I just highlighted that. Second, identify the quote. Since we are in Pakistan, Pakistani rupee is the local currency in denominator. That's an indirect quote. You need to divide. And the two rates, lower is buying, higher is selling. Last step, apply the transaction. How much you have to pay? $5,000. How much you have to pay? $5,000. The question is asking how much PKR will be involved. You have to pay $5,000. The question is asking how much PKR will be involved. Convert it into PKR. Multiply or divide. Indirect quote, divide. Since you are paying, whenever you are paying someone, you need to buy currency to pay or sell currency. When you are paying, you need to buy currency. Like for example, you are paying ACCA fees of £100. You will be selling £100 to the money changer or buying £100. You will be buying £100. So remember, whenever we pay, we have to buy currency. Whenever we receive, we have to sell currency to money changer. Whenever we have to pay, we have to buy currency. So since we have to buy, apply the buying rate, which is 0.011621, already highlighted. So 5,000 divided by 0.011621, 430255. Okay, this is how forward exchange contract works, that you have fixed the rate and this is the cost you have to bear. Now, no matter rates go up or down, you have to bear this cost. So it's a 3-step approach. Highlight the relevant row, get the quote right, and then just multiply or divide. Okay, let me tell you through one more example, then I will ask you to do it yourself, one question, and you will also be given some practice questions to do. Okay, question number 2. Listen carefully. 3-step approach. We are in UK and we must receive $6,000 in 3 months. Okay, we are in UK and we will receive inflow $6,000 in 3 months. Rates are dollar over pound. Spot today's rates. 2-month forward rate if you contract after 2 months, this is the rate. 3-month forward rate if you contract for 3 months, this is the rate. Question is, how much pounds will be involved in hedging and forward exchange contract? And what is the need of forward exchange contract? You are in UK. You will receive $6,000. You're in UK, you will receive $6,000. Is there any risk? Yes, the rates may go down. You're in UK, you will receive $6,000. Is there a risk? Yes, the rates may go down. So you need to hedge it. How much pounds will be involved in hedging under forward exchange contract? So if it is last forward exchange contract, apply 3 steps. The first step, relevant row. Since you will be receiving 6,000 in 3 months, only highlight the 3-month row. There's no need to highlight any other row, only the 3-month row. Step 1, yes. If I'm going to pay after 3 months, I will only highlight the 3-month row. Okay. Second step, GOAT. You're in UK, right? What is the local currency of UK? Pounds. It's in denominator. Indirect quote. Local currency in denominator, indirect quote. Again, divide. Lower rate here is the selling rate. Sorry, lower rate is the buying rate, and the higher rate is selling rate. As per indirect quote, lower is buying, higher is selling. So, last step. The row has been highlighted, the quote has been made. The last step. How much you have to receive? $6,000. You will be receiving $6,000. The question asks how much pounds will be involved in hedging. The question asks how much pounds will be involved in hedging. You need to convert it into pounds. Multiply or divide? Divide. Indirect or divide. If you are receiving $6,000, you will sell or you will buy. If I have to make payment, I will buy. But I am receiving money, I will sell it to the money changers. So apply selling rate 0.82. 6,000 divided by 0.82. It's 7317. Okay, these are again dummy rates. I'm not checking the real rates, but this is how forward exchange contract marks. Relevant row, decide to multiply or divide, indirect quote, and finally whatever is the amount, either multiply or divide. In payment we have to buy, in receiving we have to sell. Okay, so you can copy these 2 questions, and then after that I will be giving you some more questions. Okay. Okay, now I want you all to spend 5 minutes and do these three questions which are coming on your screen. Okay, quickly, be quick, 5 minutes and do these three questions. And then I will give you two further questions and then we will move forward. Okay. Okay, so if we talk about the first question, in the first question, we have to pay $2,000 after 4 months. Obviously, there would be a fear that rates may go up. Rates are as for $1 over PKR. How much PKR will be involved in a forward exchange contract? 3 steps, 4 months, highlight 4 months, identify the quote, pack rupees, denominator, indirect quote, division, lower is buying, higher is selling. Okay, we have to pay $2,000. How much PKR divide by a buying rate, because we have to buy to pay. 163934. Okay. Second, we are in Pakistan. We have to pay $1,500 after 3 months. Currency, it's our PKR over dollar. Now, pack rupees is the numerator. It's a direct quote, multiply. Lower selling, higher buying. How much PKR will be involved in hedging? Again, 3 steps. We have to pay after 3 months. Highlight the 3 months. Count is direct, so the multiplication, and the lower is selling, higher is buying. Okay. So 94 is the buying rate. We have to pay $1,500. So conversion PKR multiply, we have to buy is the higher rate. 1,500 into 94, it's 141,000 PKR. And question number 3. You see, it's just easy if you know the rules. We're in the UK, we have to pay 3,000 dirhams after 6 months. Only highlight 6 months. Rates are dirhams over pounds. You're in UK, pounds is in denominator, indirect quote, division, lower is buying, higher is selling. You have to pay 3,000 dirhams. Multiply, divide. It's an indirect quote. Divide. Lower is the buying, you have to pay, you have to buy. 6.61. It's 90 pounds. Okay. Any questions you can ask? Do the next 2 questions, please. Okay, now next two questions, and I think you have got enough information about forward exchange contract. Next question states we are in UK and will pay 3,000 euros after 4 months. The first thing I have to do is, and my relevant row here will be four months. Okay. The second thing is that I'm in UK. I have to pay 3,000 euros. UK's local currency is found in numerator. Direct quote, multiply. As per the rules, lower rate is the selling rate, higher rate is the buying rate. Okay. Last transaction, pay 3,000 euros. Multiply, divide, multiply. You have to pay, so you have to buy 895. 2685. Okay. Next question. We are in Thailand and will receive $2,000 after 2 months. Rates are 2-month row. We're in Thailand. Thai baht is a numerator. It's direct quote. Multiply. Lower rate is the selling rate. Higher rate is the buying rate. Okay. So it's $2,000 receipt. How much bahts will be involved? Multiply to convert. You are receiving. You need to sell. Multiplied with the selling rate. It's 54,000 Thai baht. Okay. So we have discussed 5 techniques in today's class. Deal in home currency, pay or receive money in your local currency, leading, early payment, lagging, late payment, matching, offset receipts payments, forward exchange contract, fix a rate for a future transaction. It's a 3-step approach, relevant row highlight, count, and then finally payment by receipt sum. Okay, hope you enjoyed the lecture. Thank you very much. We will meet in the next class with the next technique, that is money market hedging. Okay, thank you.